Welcome to the Salty Investors Christmas edition. That's what we're going to call it. It's the 23rd of December, 2022. Last podcast of the year, Tim. How are you?
Yeah, pretty
Feeling
good yourself.
jolly? You got this? Oh,
Have,
yeah, I wouldn't say jolly, but it's going to be a bit of festive stuff going on, bit of relaxing.
hmm
Can't complain about that.
Yeah,
Been a busy year, especially this time of year when it's hot. You don't want to be out running around like an idiot.
yep.
Um, so that'll be good. How about some salt this week, Tim? What do you got for us in the
Oh,
festive season?
it's hard to be a bit salty coming up to Christmas, but I'll try.
Mm.
I think people are still, in this delusion of, they're fighting the Fed, and that's I'm just a bit
Mm.
salty for them, thinking, I was on the opposite side, fighting the Fed when they're cutting rates, so I know what it's like
Mm.
to keep
Yeah.
keep fighting the Fed continually.
Yeah, I fought him for a decade
Yeah. So I'm not criticizing it. Like, I know what
and
it feels
lost.
like. Yeah, and I lost pretty hard, so I know what they're going through. But yeah, the market, we're only 7% off the bottoms of the year now. So that little correction in
Mm.
the last couple of days. So
Yeah.
um, yeah, it's not looking good going into next year. So that's all I'm salty. What about you? What are you salty about? You got any?
I listened to some. I listened actually. The Animal Spirits podcast had a guy on who is. They have a segment called Talk Your Book. So they get someone on from the investment community to spruik a product or something. And this guy is basically, I wouldn't call him anti ESG, but I think what he calls them are the orphans. The things that are left out of ESG. So they
Mhm.
would be your sin stocks of tobacco,
Taka,
alcohol, and of course your
gambling.
mining,
Yeah.
gambling. Yeah. And what was so the salt is just what he was explaining about the type of things that are included in ESG,
Oh,
which
yeah. Apple.
it's such a it's such a joke. Yeah. So you can go through all the companies that are included, for example, that have sweatshop labor or something like that. But one of the ones he pointed out was that I think alcohol and tobacco apparently cost the US government or the health system $700 billion a year to treat alcohol and tobacco related illnesses, right? Um, Diabetes costs $1 trillion, I think, something like that.
Wow.
Um, it's anyway. Whether the number's more or it's half or anyway, but Coke and Pepsi are the number one contributors apparently to that. But of course, Coke and Pepsi are in all the ESG portfolios. That's just one example. And there was another one he said, like, well, weapons, Walmart sells guns. Dick's Sporting Goods sells guns, so they're not excluded. So the thing is, I guess there's two ways to go with this, which is abandon ESG altogether, which is they won't do, of course. But then what you're going to do is you're just going to end up with an ever-growing list of things to exclude. So if they want to be consistent, they would have to exclude Coke and Pepsi, and they would have to exclude Walmart, or say that, I don't know, you can't have a equal weighting of Walmart because
Yes.
it sells guns partially or something like stupid like that. So then it just becomes ridiculous, and then you're getting further and further away from the idea that your job is to actually provide a consistent return over time for people, and that just excluding all these things is going to cost you in the end. Your returns have to be lower. They have to be. It makes no sense. So
Well, it opens up
yeah, I think it's
opportunities. Yeah, that's a good thing about it. If you
yeah,
look on the other
yeah,
side of it. Hmm.
yeah. So it's just contradiction, and it what it in a broader picture, what it says to me is you just have now a new generation of Puritans, right? That want to tell you how to live. They want to tell you what you're allowed to invest in, and that if you drive too much, you're going to be punished. And if you don't have, it seemed, it's like when in the 1980s, when I was a child, growing up, my formative years, if you like, um, all the sort of social cultural censorship came from the right, the religious right,
Yes.
generally speaking. I started listening to heavy metal music in the mid 80s, and they were trying to ban it,
Yeah.
because Motley Crue had a pentagram on their headbands or something. It was completely ridiculous. But it all comes now from the other side of politics, and it's all it's a different type, but it's just a new sort of puritanism where we want to tell you we know better for you how you should live, and we don't want individual choice. And the way we're going to do it is more subtle than just banning you or ostracizing you. We're just going to make it more expensive for you to do the things that you want to do.
I remember the heavy metal one, and the leftists used to say, "Oh, if you don't like it, just don't listen to it." That was their argument. And you're just like, well, surely the shoe's on the other foot now, but no, we need to actually ban it. But my fear is like if they take this one step further and they go, okay, super funds need to be now ESG or some whatever scheme they come up need to be compliant, because we're trying to look out for the long-term wealth of pension funds. They got levers there to pull and really move it in one direction, which would be very nasty. But we'll have to see what happens.
So that's my rant. So well, given it's Christmas cheer, do you think we should have some anti-salt?
I don't know. Yeah, probably.
Optimistic about, feeling good about from 2022, or even looking forward into 2023? Anything?
Well, I'm pretty happy with our record
of that nature. Christmas cheer.
Well, like our record on here has been, don't panic. Let the Fed do the work. Let them go through. And I think if you've sort of listened from the beginning, I think we've got a pretty good record on here of what to do. Not that too many people are listening, but all the chaos that's going on at the moment. I think if a few more people took that advice, I think they'd be in a better position right now. But
oh, don't worry, mate. In 100 years, the archaeologists will find this podcast and go, see, should listen to these guys.
I don't know. Like, it's just surprising. Like, not that I'm good at predicting the future, but just the emotions that have been going on, this year have been intense, like, with the war and the Fed changing direction and all that. Like, a lot of people are losing their don't have this thing called temperament. Obviously, it's coming out to show right now. And they shouldn't be in this industry. I think.
I just think that people are, what's the term, fighting the last war, in a sense that they still, most people are still thinking that, all right, we're going to go back to a low interest rate environment within the next 12 months, and it's pretty much do what we did before. Maybe rates will be a little bit higher. Instead of being 0, they'll be 2, but and I just think that there's a step change. I think the secular low in bond yields or in bonds it's happened, and we're not going back to that world anytime soon. And if the only thing that would get you back to that world is a GFC type event, and then things to worry about under that scenario. But I feel good in the sense that didn't run out and buy stocks. I mean, it's still to be seen. I mean, you and I both think that the stock market I think it's fair to say, is headed for lower lows in this cycle before we're done. That's yet to be seen. But I think you're right. We still look good at the moment. We haven't panicked. Just been trying to fill out the shopping list, which is not yet complete, and get that ready for the moment when the moment comes.
I'm just not sure when that pivot's going to happen, where I'm going to have to go start putting a tranche in here somewhere, but it's getting closer, I think. I think next 2 months we'll have to really be serious about it and actually take some action. So what are you happy about? What's your anti-salt? Have you got any?
I mean, no, I suppose, I mean, I don't want to sound like Mr. Schadenfreude, but I am kind of happy that an era of excess is in the process of coming to an end. And we can get back to more reasonable in terms of markets, I think politics just gets worse and worse. But markets, at least, that there's a discipline that's going to be imposed by um, a higher interest rate, and that companies, and that it's just a higher hurdle rate, and things that happened in the last few years just won't be able to happen in the next few years. SPACs and all this sort of dog shit. What 90% of the crypto world is just junk and fraud, and there's one big happy highlight. You can see that SBF is now some of his senior executives have flipped on him, basically lumping it all onto him. So I wonder how Bill Ackman's feeling about his statement that he believes SBF now. But that's good to see. It's good to see fraudsters held to account. We'll get to see what'll actually happen to him, but
makes the case of it's just things went wrong. That doesn't sound like that's going to hold up. Like, it sounds like if they've been charged with fraud.
I made a couple of bets and went against me. Yeah, it's just it's not going to hold up. I'm just happy about a more sane investment environment. We discussed offline. I don't want to spend too much time on this, but seeing on live wire markets some of the professional fund managers owning up to their mistakes, which is good to see. Like you do, it's a healthy thing to look, because I know when I was younger, you tend to just ignore your mistakes, right, rather than actually learn from them. But just seeing some of those people, like, oh geez, we had a big position in Xero, and I'm like, I've been running valuations on Xero for years now, and I can't get anywhere near the stock price. And I just and so you have to ask, like, these professionals, like, do they have a discipline, and did they deviate from that discipline because of market conditions? So that's what it appears like. And then you just think, well, they're not that professional. I mean, I say that as someone who's, hey, I'm not anywhere near professional. Well, I guess it just shows we're all human at the end of the day.
Don't take it too seriously. Don't think you're a big know-it-all. I think that's quite positive. If you have that bit of humility about yourself, I think you need that. So which is good.
All right, well, let's move over to have a look at. I just thought this was interesting. It's popped up. This is Australia, CanStar. They do all these. Probably heard of CanStar. They do all these consumer survey reports. So it's just a report came out. The last time they did it, one was, I think, in April. So it's 6 months or so since they did one, and you can just see there that 32% of people, if they have higher interest rates in their mortgages going forward, 32% of owner-occupied mortgage holders will need to cut their living costs further. So, I'm not predicting some implosion in consumer spending. Consumer spending very rarely goes backward, but there's going to be a shift. People are going to have to pull back. I mean, look, at the bottom there, only 5% of the people say that they'll have to contemplate actually selling their apartment or house, and 6% of investors. But so that's fairly reassuring. But I mean, you're just going to, as we've been saying all along, there's going to be increased after Christmas gets out of the way. What happens to consumer spending? How well will it hold up?
That 5% and 6% numbers down the bottom, I think, a little bit delusional. Like, that's assuming that rates are basically going to stay where they are now. That's the current narrative. So,
well, the question is, are mortgage holders prepared for even higher interest rates in 2023? So the question implies that you will have higher interest rates. It's not assuming they'll stay the same.
Okay.
So but whether it's, but again, I mean, to me, the thrust of it is just more pressure on discretionary spending, people pulling back. And where does that show up? It's to show up in discretionary retail and other things. So that was an interesting one. Now, I pulled this from Howard Marks's latest Oak Tree, the memo.
Quality, yeah.
So, yeah, they're always a good read. What's disarming about Howard Marks is he this is what I think, this is the sign of someone who knows what they're talking about, is that they write so simply, but the lessons are so clear. It's like Buffett. Buffett's attitude to investing is so simple, it's almost boring, but it works. But very few people do it,
Yeah.
And so Howard Marks, this is the sort of thing, that table's very interesting. So, look, sort of the 2009 to 221, everything's so positive.
Yes.
But what I want to draw attention to is the bottom line. Prospective returns, lowest ever. Okay.
Mm-hmm.
And people will look at that and say, but we just had a period of double-digit returns for more than a decade.
Yep.
But the point is that's all pulled forward, and you can't expect that. And by the way, of course, he's a bond investor, and he's talking about bonds here. Well, he's talking about investing in general, but he's a bond guy. So as he says in the bottom there, is it up the top there? Oh no, down the bottom. In the today column, it says more than ample prospective returns. I don't know about. I don't think he's talking about stocks there, because if you look at the valuation of stocks, they're just. You would just have to have a repeat of the last decade to get ample returns from stocks, which, as we've said, probably not going to happen with ultra low interest rates, easy money. So, the bottom line, he says, is that in many ways, conditions at this moment are overwhelmingly different, mostly less favorable than those of the post-GFC climate. These changes may be long-lasting and they may wear off over time, but in my view, we're unlikely to see the same optimism and ease that marked the post-GFC period. So again, it is the belief that there's been some kind of step change, some kind of long-term change in the 40-year declining bond yields regime that we've been in, where everything just got easier and easier and easier through various cycles. So that, when you read this stuff, I don't know if you have the same reaction. I go, yeah, that's just so obvious and common sense. But people just don't invest that way. They don't invest on common sense.
Yeah, but I think the markets still think the inverted V is on. If the rates, the Fed's going to cut quickly here. It's gone up steep, but it's going to come back, with a vengeance down to the other side. But what he's saying here,
even if they tell you they're not.
Even if they say the opposite. But the market still believes that. And he's saying here, there's a structural change in the whole market here. But you hear many people, I hear a couple of people saying, oh, we should be buying double line, thinking the long end bond. And I'm like, wow, that's crazy. But the short end sounds a lot smarter to me. And I know, he'll be doing in all sorts of, loans and all sorts of stuff. He really looks hard, in China, he's in China, so not afraid to look around a little bit. But I don't know if people are conditioned to that. It's so simple, like you said, and you're getting, 20 factors here blinking in your face saying, do it, what change your thinking, but I don't think many people are. So.
Well, have a look. I mean, probably best not to do this, but go on Twitter and have a look at the sort of Tesla fanboy crowd. They're stuck in the narrative. They're stuck in the narrative of the genius, and there's going to, basically the world is going to be taken over Tesla, and there's, no one's going to own a car. We're all going to be going around in robo taxis, all owned by Tesla. And just was it yesterday or the day before? Fully self-driving Tesla caused an 8-car pileup somewhere in California. Once again, this happens all the time. Elon Musk has been selling full self-driving for 5 years, and it doesn't exist. People pay for it, So I think Tesla today at $125 is now on a PE trailing 12 months of 38 times. So and by my calculation, it only has to come down about another 66%, and it'll be in line with other automakers. But you have people. I saw a guy there today who said he had, because he's leveraged long Tesla, he had to sell some.
And you got Musk
these people
selling. He's don't worry about everybody else. Musk is there selling all your, to cover the.
No, I just use that guy as an illustration of people who've just. There are people who put their entire life savings into Tesla. It's bizarre. It really is bizarre. And I'm sure. I mean, Tesla's been going. It's due for a bounce. It'll get a rip.
Yes.
Sooner or
sure.
later. But it's just another example of that mindset that Tesla's going to be the first $10 trillion company, and I think they're delusional. Well, I've been saying people are delusional about Tesla for about 4 years now. So, and I've been wrong for 4 years.
But I'll see the markets take into account. Elon's spending too much time at Twitter. You heard it first on our podcast. And now the market has started to caught onto that and going. You saw he put a poll out. Should I still be the CEO of Twitter? Or CNBC is like having all these things saying he needs to get over. And
the thing about when he puts out a poll like that, when he puts a poll out like that, he already knows he's going to hire another. I mean, everybody knows he's going to get another. It's not like, oh, the poll told me I better step down. It's bullshit. I mean, people haven't cottoned on to Musk already. I mean, he's full of shit all the time. The difference between what he says and what actually happens is, I mean, there's a whole website devoted to it. I think it's called Elon Really Said That or something. It's just, it details. Well, there's literally hundreds of things that he said that just complete nonsense over the years. So I don't pay much attention to him. But obviously, you said this about 3 weeks ago on this podcast, didn't you, about him spending far too much time on Twitter. I mean, I think his biggest problem, he's actually addicted to Twitter. I mean, he can't stop tweeting about just anything. And then he ends up retweeting conspiracy theories and all kinds of bullshit. And he's, I think what he's done with the revelations of the Twitter trust and safety people and FBI entanglement, it's all very interesting. I'm really glad that's become transparent. But it did just sort of confirm what we knew, what was going on at Twitter. If you had certain political views, you were going to get blacklisted, censored in some way.
But
that's true across all social media.
But he's not invincible. They put him up on this pedestal. Like, he can do everything. And I'm like, wow, this guy is like, he's going to lose it here. Like, there's no way you could run complex companies, this complex, like SpaceX, putting rockets into space. We used to say, oh, you're a rocket scientist to be smart, and this guy's running that company, plus Tesla, plus he's got Twitter. Like, most mere mortals could handle like half of Twitter, Yeah,
but is he running SpaceX? Is he? You know what I mean? Like, what is his day-to-day involvement in SpaceX?
Well, that's a problem. Like, a CEO, should have his hands in, speaking to heads of departments, where is capital being allocated? That's I see as a CEO, the most important thing is where you're going to allocate capital and resources. How can you do that on, 2 hours a week? Like, unless you, if I was a shareholder,
unless you've hired people to do it for you. That's what I mean. Like, who really runs the day-to-day of SpaceX? I mean, Musk clearly doesn't. Somebody else must be doing it. So,
but that's dangerous.
Anyway.
I don't know. Yeah. There's risk involved in that.
Yeah, I know. I agree with you. I agree with you. Yeah. Anyway, we'll move on from Howie. So I just put up. Hussman also had out. He puts out a monthly comment. This, I think, it was back on December 11th, and so just going back to reinforce the point about prospective returns. I mean, so this is non-financial market capitalization to non-financial corporate gross value added, including. So this is basically the Buffett indicator, but refined in the Hussman way. So Hussman finds that when you do it this way, he gets a better correlation with subsequent returns. And if you just have a look where it is, like this is basically the Buffett indicator. Look where it is. It's still more than 2 times. So
are they standard deviations or how do you get those? What are those lines there? Is that the third
No, I think isn't
quintiles?
it two?
Interquartile. Okay.
Yeah. So it's non-financial market cap is 2 times GDP. You know how Buffett's so yeah. I think that's what he's doing there.
Yep.
Yeah.
I think the Buffett one is out of control as well still. So it's not like we'll share.
And remember, it's a rule of thumb. It's not some ironclad rule that as soon as it gets to a certain level you should sell or whatever. But it's just reinforced the idea that valuations aren't cheap. The stock market isn't cheap on the whole.
Yep.
There might be pockets of value, but yeah. So I think it just I'm very aware of reinforcing my own bias that the market's still got to go lower, but a lot of the signs that you want to see just aren't there. I mean, in March of 2009, the PE on the S&P got down to about 10 or 12 or something, very briefly. I mean, literally for like 3 weeks or something, but at least it got there. Not this time.
Yeah. Well, still could be early.
Yeah. Alrighty. So you have Docs. Who's Docs? Doc Martens. Yep. Is that who it is?
Yeah, you might have had a pair in your younger days at all, or bought a pair at all? Or?
Yeah, I don't know if I did. I know. I remember my mates had Doc Martens. Yeah.
Yeah, so they're normally
wasn't that cool?
Yeah. Well, I never had money, and so had to wait to university to get money, and I bought a pair, but I never bought the proper. I just bought the short pair. But obviously, they're a high quality brand, and I think a brand like this will last over more. It's going to have swings, but it's going to be popular and then unpopular. But you can see here, this is one of these IPO type stocks. Not that long ago, and you can look at the numbers. It's just imploded.
What happened? Yeah, what happened?
Well, the market. What happened? It's in London Stock Exchange listed company. Yeah. And just concerns about consumer discretionary. You buy a pair of shoes, you don't really need to buy them, every year. Good quality pair of shoes. And so, but you look at some of these numbers here. The price to free cash flow. Not too bad.
Yeah.
And returns on your one returns on equity here are like insane.
Returns on invested capital are pretty good too.
And these gross margins, they're still holding them up. Like now they've moved manufacturing from the UK over to I think Thailand and maybe even Vietnam, so they can really hold these high gross margins. And the thing I'm looking for is like if it becomes popular in China. I know everyone forgets about the Chinese consumer now, but they're turning into a middle class. So over the next decade, if they really latch on to some of these iconic, Western type brands, as they have in other areas, you look at the luxury, the brands they've done, but a little bit step down from that. Would they, grab onto a brand like this? But this is going to get some pain. Like, like you said at the beginning of the podcast, consumer like this is really going to go through some hell here. If interest rates keep going, like, but
at some point, retail is going to be a fantastic buy. But good luck with the falling knives there.
Yeah. So I'm back to my old school thinking. Wow, like look at this. Like at some point here, this brand will survive. I think someone will buy it. I think it'll survive. It's still got value, and it'll have resurgence at some size, especially if it resurges in China or Asia. They got more money. So it's just one of these ones that I'm trying to, increase my circle of competence a little bit more, like trying to get out of staples a little bit, because everybody's ficking in there. Everyone, like you said, everyone's hiding in there.
Yeah, that's the problem with them. Yeah.
I've got no room to go in there, so I've got to learn a little bit more. So what do you sort of think? What do you think on Docs or?
Yeah, I mean, so if you look at some of the investors that we've looked at in the last that you've brought to the table in the last couple of weeks, they tend not to hold retail stocks, right? Because they're cyclical. Mm-hmm. They're not the kind of thing that'll hold up particularly well. I mean, you exclude things like Walmart, even though they are really retail. You exclude those type of businesses. We're really talking about the more discretionary stuff, fashion stuff, right?
Yes.
They tend to exclude that stuff, and you can see why. Risky. These guys, what's their debt like? Have they got much in the way of debt?
Yeah, I don't think it's too bad. Like, they
Yeah.
weren't loaded up with a whole heap. Obviously, the share dilution just went insane, but it's just held steady
Yeah.
the last 2 years. So I think,
So
yeah,
my view on retail is you want to look at ones that aren't leveraged, because if you get one that's got a lot of debt, that's and you come into one of these cycles where you've got too much inventory, now you have to discount. I mean, that leverage can really smack you around, because you can look at it. Okay, they've got a lot of debt, but they've got 2 times interest cover. It's fine. But then you get one bad season, and all of a sudden now you can't cover your interest. It's seen a lot of retailers go that way. So what do we got here, Tim? We got some geniuses and their returns over the last 1, 3, 5, 10 years. You want to walk us through this one?
Yeah, well, last week you asked, what are their returns? Like, how good are these people? We just looking up to these people thinking they know what they're doing. But as you can see here, like, you can't really look at the 1 or 5 year really, but I did 10. So this is 13F. So, but I think that's hasn't got everything in there. Like, they could be doing things outside that, but just gives you a general idea against the S&P 500, and a lot of these people aren't really performing versus the hardest index in the world for the last couple of decades.
Yeah.
But you see here a couple of people doing good, like
Howard Marks. So interestingly, in that last memo, Howard Marks said in the recent years their returns have been, I didn't say subpar, they're muted or something. So that, I'd say, huge part of that return was because they went out and raised an absolute shitload of money in 2008 and started buying the hell out of
everything,
distressed debt. He timed that absolutely beautifully.
Yeah. But you got to be smart to do that. Like, that was a lot of fear then. Like, but he's like, obviously, his head screwed on here properly and knew the best time to do it was then. And but you look at these other people, Kathy Wood, 53%, and you compare that against, the S&P 500, just getting obliterated here.
I'm surprised by Tepper, because Tepper was one of the earliest people to come out in like 2013, 2014 and say, look, don't fight the Fed. You got to be invested. That's what Tepper was. Tepper was early on that, but his returns haven't been that great. I don't know why that is.
Yeah. So you can see the S&P 500 is 137.
Yeah.
And then Tepper's a little bit underneath that, but like, it's all cycles as well. So, you could be just investing in the wrong part of the cycle, but your strategy's great, and as long as you're close to the S&P 500, I haven't really got a problem with it. Like, even Einhorn here, he's at 109, and it's 137 on the S&P. Like, it's not terrible. Like, it is, over a decade, you'd be a bit of pain. But, you're thinking, okay, well, the cycle turns now to value. You'd be thinking, you're giving up an Einhorn now, and then he has, 10 years of good running. You'd be like, oh, what the hell did I give up on that, just because it was a few points behind.
What's happened to Soros? What's he been doing? Has he just been too busy funding social justice causes or something, has he?
Well, he doesn't really, his stuff, doesn't really show up on 13Fs, like he's like on big play type stuff, and then he gets out of it, and then so he's not sitting in things. So it's not really not something that you and I can probably do. He's one of these guys that are like, are really specialized. You can't go, oh, I'll just do whatever he does. Like, you're freaking delusional. Like, there's no way that you can survive. But like Joel Greenblatt there, like, he's basically doing a little bit better, and he's got a strategy that isn't very hard to understand. Howard Marks is another one. If you think you can do what he does, like, I think he might talk simply, but the markets that he's in, credit markets and stuff, you have to be quite sophisticated.
Yeah, he's been doing it. He's been doing it since the 70s. I think he probably has
And Jim Simons, there's another one. Or, Burry, if you think you can do what Burry does, I think, you need a little bit of humility here. Even Ackman, I think he's got a strategy that most people could sort of semi-follow.
Yeah.
You just compare it to Buffett here. He's under as well, but they don't do too well in these bull markets. Terry Smith, I've been reading all his letters, and he's done, these bull markets are terrible for us because, we've got all this, we're trying to be conservative here. It might look like he's buying whole multiple stuff, but he's buying stuff that's got great balance sheets, and, they can service their debt very easily. It's just a few people surprised me here, like Tom Russo.
What's good about the Burry thing is that, he made all that money during the financial crisis, but this period of returns is after that, right? So he's still managed to outperform quite well post that.
But he changes stocks every 3 days, like you can't, it's impossible to understand him. Like, really sophisticated. Like,
he talks in riddles on Twitter too. He just sort of vague allusions to things.
So most of these guys held up, like Poland Capital, Acre, Terry Smith, obviously the guy that I think is somebody that everybody could follow if you want a little bit of outsized return without spending, 20 hours a week trying to understand this stuff. So, a couple of these guys actually have proven themselves to actually perform. So it's going to be interesting how they go through the next, 2 years. That's all.
Yeah. All right. We might leave it here for 2022. That's the last podcast for this year. Thanks for listening, all three of you, and we'll see you in the new year.